All right, welcome back, active traders, to today's explainer. If you are looking for that macro edge in today's market, you are definitely in the right place. Today, we're serving up a tactical contrarian briefing, specifically unpacking all that noise surrounding the March 2026 labor data prints. Our goal here is pretty simple. We want to decode what the headlines are screaming at us and isolate the true underlying signals that actually move markets.
Because, if you flipped on any financial network lately, you are being sold a very specific story. You're being told the job market is roaring back to life. But we really need to pause and ask ourselves right out of the gate, did the labor market actually just heat up, or are we looking at a massive, well-disguised head fake? As contrarian traders, our edge lives right in that gap between the mainstream media's narrative and the actual cold, hard data.
In the mainstream narrative, well, it's currently clinging for dear life to this one number, 5.6 million. That is the headline hires figure for March. It represents a massive 655,000 monthly jump, literally the highest level we've seen since February of 2024. The wire services are pushing this specific metric everywhere as undeniable proof of a reaccelerating, heating economy. It's an easy headline to write, right? But for us, man, it is absolutely the wrong number to build a trading strategy around. Okay, let's dive into this and look under the hood. If you peel back that single number, the context tells a completely different story. Yes, for sure, hires spiked, but job openings actually fell again to 6.87 million. That marks the fourth decline in openings in just the last 5 months. Meanwhile, layoffs and discharges climbed to 1.9 million. So this isn't a heating market, it's a market churning through a softening trend. More workers are getting hired, yeah, but more are also getting fired, and there are fewer total jobs available across the board.
To truly figure out where we are in the cycle, we have got to look past the noisy hires number and zero in on the hidden metric the headlines completely glossed over, 0.95. This is the openings to unemployed ratio. It literally means there are now fewer job openings than there are unemployed workers. For active traders, this is the real leading indicator you need to watch. And honestly, more importantly, this is the exact metric the Federal Reserve has explicitly cited for years to justify keeping rates restrictive.
To grasp just how massive that 0.95 ratio is, let's look at the historical context for a second. At the peak of the cycle back in 2022, this ratio was sitting near 2.00. That meant 2 open jobs for every unemployed worker. It was insanely tight. Even in the 2018 to 2019 pre-pandemic era, the norm was roughly 1.20. At 0.95 in March 2026, the labor market isn't just cooling, it actually has less demand-side tightness than the pre-pandemic economy. The Fed's preferred labor market tightness gauge has fully, undeniably rebalanced.
And this brilliantly illustrates exactly why that matters for the whole inflation fight. The New York Fed's HPW index, which is a highly sophisticated measure of labor market tightness, is moving in absolute lockstep with 3-month wage growth. As our key labor metrics, like that vacancies to unemployment ratio we just talked about, continue to fall, they drag wage growth down right along with them. The data is practically screaming at us that the wage price spiral threat from the labor side is effectively dead. But here's where it gets wild. Beneath those macro averages, the internal sector volatility is off the charts. We are currently trading in a highly segregated labor market. White-collar and tech sectors are just bleeding. Information sector openings are down 33% year over year. Federal openings had plummeted 41%. Yet somehow, retail trade openings are up 58% and manufacturing is up 18%. The pain and the growth are living in completely different zip codes right now.
The researchers over at the Indeed Hiring Lab actually hit the nail on the head with this. They wrote, "Stability in this market is less a general condition and more a matter of where you are standing. A software engineer facing AI disruption and a retail worker seeing surging job availability are living in 2 fundamentally different economic realities today. It's like a tale of 2 economies."
Now, for those of us trading cyclical trends, there is one sector that absolutely demands our immediate attention: professional and business services. I want you to think of this sector as the cyclical canary in the coal mine. In March, openings here plummeted by 318,000, and simultaneously it experienced the largest increase in layoffs of any sector out there. This tells us that white-collar cyclical demand is quietly but aggressively contracting on both sides of the ledger. That expanding layoff cycle that started building back in 2024, yeah, it's still rolling.
And the epicenter of all that white-collar pain? It remains the tech space.
While the U.S. average layoff rate sits relatively low at around 1.2%, the information sector, which obviously houses a ton of tech roles, has surged to a 2.4% layoff rate. That rate has nearly doubled over the past year. With firms actively citing AI disruption and restructuring, this is a massive, hidden headwind for tech-adjacent services that the broader market indices probably haven't fully priced in yet.
So the crucial point we need to take away is that worker psychology has fundamentally shifted, and we measure that through the quits rate. After all, workers only voluntarily quit when they are confident they can cross the street and snag a bigger paycheck somewhere else, right? Right now, that confidence is fading fast. In March, the quits rate sat essentially flat at 2.0%, which is down meaningfully from 2.2% a year ago. Workers are job switching at exactly the 2025 pace, meaning that aggressive quits-driven wage inflation of 2022 and 2023 is fading away, not re-accelerate.
Furthermore, the forward-looking indicators confirm that this softening trend is likely going to continue. The ISM employment surveys for both manufacturing and services are flashing big red warning signs. Both printed well below 50, putting them firmly in contraction territory. Because these ISM indices tend to lead the BLS labor data by a month or two, this pipeline suggests we should absolutely expect further softening in hiring and openings as we head into the summer months.
The execution, a tactical trading playbook. Let's move on and see how this all builds together. Understanding the data is only half the battle. Knowing when and how the market will react to it is where the profits are actually made.
You're going to want to mark these dates on your calendar. These are your upcoming trader catalysts. First up, May 8th, the non-farm payrolls print. This is a direct test of our cooling narrative. A weak print confirms our read. A strong one forces a total reset. Then May 12th brings the CPI, which dictates if the Fed actually has the runway to cut rates. On May 15th, Kevin Warsh takes over as the new Fed chair, inheriting this exact economic puzzle. And finally, June 2nd is the next JOLTS report, which should confirm whether that 0.95 openings ratio continues its drop.
All of this timeline culminates in what we are calling the macro box setup. Basically, the Federal Reserve is trapped. On one side of the box, they finally got exactly what they wanted. The labor market has undeniably rebalanced at that crucial 0.95 ratio and wage pressure is fading. But on the other side of the box, the inflation regime never cooperated. ISM services prices just hit a 4-year high of 70.7, and geopolitical tensions have Brent crude oil pinned between $108 and $113 a barrel.
Which leaves us with the ultimate question driving the markets right now. The labor market is absolutely screaming for rate cuts, but will the stubborn inflation regime actually allow the Fed to execute them? How the new Fed chair navigates this incredibly restricted policy box is going to dictate market direction for the rest of the year. Keep a very close eye on that 0.95 ratio, watch those white-collar layoffs, and remember, always trade the data, not the headlines. We'll be back to unpack the next print. Catch you then.